Welcome, and thank you for tuning in to ESG Talks, a KBRA podcast series focusing on environmental, social, and governance (ESG). This podcast series highlights various ESG hot topics and includes commentary from prominent voices within the ESG community. In this episode of ESG Talks, Miten Amin, a managing director on KBRA's business development team in London, interviews Tina De Baere, head of ESG and Macro Strategy at Cairn Capital. Cairn Capital is a London-based alternative credit asset manager with $6 billion in asset under management. Tina joined Cairn Capital in 2008 as a portfolio manager. From 2017, Tina's focus includes ESG, and she spearheaded Cairn Capital's push into responsible investing. Tina developed Cairn Capital's ESG strategy and policy for all of the firm's asset classes, including high-yield bonds, leveraged loans, and securitized products. Tina works closely with all stakeholders, including the investment team, shareholders, and the board. Tina serves on Cairn Capital's General Management Committee and the Diversity and Inclusion Committee. She also serves on the PRI Structured Products Advisory Committee and is the co-chair of the European Leverage Finance Association's ESG Committee.
Hello, it's Miten Amin here from the Business Development Group in London at KBRA. As Emily mentioned, we are thrilled to have Tina De Baere here from Cairn Capital join us today. So let me kick off. Tina, as you're well aware, interest in ESG investing has exploded over the last few years and has only accelerated throughout the pandemic. Why is ESG important to Cairn Capital, and how has your strategy for ESG evolved?
Thanks, Mitten, for having me here today. ESG is important to Cairn Capital because we care about our planet and our people. We started our ESG journey a few years ago, back in 2017, and this was when we began to get more investor inquiries about ESG and responsible investing. Subsequently, senior management here at Cairn Capital agreed that ESG was an area we needed to explore. I volunteered in doing this, so I set up our ESG framework and wrote the firm's ESG policy, which is published on our website. And we also signed up to the PRI to get us started, which is a great resource when commencing on this journey. So what we have in place now, we adopted a two-pronged approach. So firstly, we have a top-down approach where we apply negative screening, excluding certain business activities from our investment universe. Secondly, we have a fundamental bottom-up ESG integration approach, where we explicitly and systematically integrate ESG factors into our investment process across all our assets on the platform. The actual process may slightly differ depending on the asset class. So, for example, the ESG analysis will be different for a bond from a publicly listed high-yield issuer versus a loan from a small private company versus a structured finance bond. But each credit memo that gets presented to our investment committee will have a dedicated ESG section. And this can be a qualitative or a quantitative ESG assessment of the issuer. Our leveraged loans team, in fact, do both. They also assign an internal ESG score to corporate borrowers alongside a qualitative assessment. And one of our next steps is to further assess the real-world impact of our ESG approach.
Thank you, Tina. Appreciate that. I know that one of your focus areas is securitization from past experiences of working with you, Tina. Why do you think ESG discussions have lagged in structured finance compared to more vanilla, non-structured sectors?
Well, since the start of 2020, I have been working as part of the PRI Structured Products Advisory Committee, and we've done some initial work on this. So on the back of this work, we published a report in May on the current state of play of ESG within structured finance. And what we found is that most fixed income investors have an ESG policy already at the firm level, but they may not be specifically tailored to securitized products yet. So in practice, investors may already be incorporating some ESG factors into their credit analyses, but this is not always done systematically and explicitly. It lacks the rigorous framework that we see already established for other fixed income asset classes. So why has ESG been lagging in this sector compared to other fixed income asset classes? Well, what complicates the ESG analysis for securitizations is that the analysis needs to be conducted at various different levels. Firstly, depending on the number of key counterparties present in a deal, the analysis can, for example, for an RMBS, be done at the originator level and the servicer level. How does the ESG profile of the originator look like? What is the servicer's arrears policy and collection procedures? And for a CLO, the analysis can be done at the CLO manager level. How is the CLO manager managing ESG issues in its business? Is D&I high on its agenda? And for a CMBS, the sponsor can be in focus. How does the governance structure look like at the sponsor? Secondly, the analysis can be done at the deal level, that is, assessing the actual securitization documents. For example, investors review the portfolio eligibility criteria and deal triggers and tests intended to protect investors from portfolio losses. And in CLOs, we may find that the documentation excludes specific industries from the portfolio. And then finally, ESG analysis can also be done at the underlying portfolio level. As you know, the underlying assets can vary significantly within securitized products, and distinct regional differences exist. So the ESG analysis for a portfolio of, say, UK credit card loans will look very different compared to a portfolio of US leveraged loans or a portfolio of French commercial properties. So in this PRI report, we go over the different layers of a transaction and what type of ESG issues can be analyzed at each level, and the possible impact these issues could have on the transaction. For example, for an auto ABS, environmental regulations and changing consumer preferences over time can affect the residual value of vehicles backing the ABS. However, data availability is a significant challenge in the structured finance sector. Although we have some data available to us, it is far from being complete to enable us to run a comprehensive ESG analysis. And the PRI report outlines what type of ESG data is available already to investors, but it also highlights the type of data that investors are seeking from originators, sponsors, and CLO managers.
Thank you, Tina. That's a great overview of the structured finance industry in Europe. It's also a great segue into our next question. There's been a rush to market of ESG data and analytics, as you're well aware, and that you've highlighted. Data in the structured finance space is not as developed. Given this challenge, can you talk more specifically about your firm's process for evaluating ESG impact within securitization?
So what we've done is we've developed a matrix where we specify material ESG topics for each asset class within structured finance. So for example, what ESG issues are important to consider for a UK RMBS? And our matrix will indicate that we need information on how an originator manages ESG issues within the underwriting process. So, for example, what is the originator's borrower income verification process and its affordability testing process? Regarding the servicer, how is the servicer ensuring fair customer treatment? How is it dealing with vulnerable customers or customers in financial difficulties? Are borrowers in financial difficulties treated fairly? Also, do services partner up with debt advisor organizations and proactively put struggling borrowers in touch with such organizations? And then on the environmental side, how does climate change risk, physical and transition risk affect the underlying portfolio? And if you don't have the data available to us, we ask the originator or the servicer for this data.
Thank you, Tina. There's also been a rise in ESG labeled products like green bonds and sustainability-linked bonds. But with this increase, there have also been questions around greenwashing. How can you ensure the assets you're investing in are truly sustainable?
That's a really good question and a very relevant question. Apart from the lack of data, this is another major challenge for investors at the moment. So in recent years, we have started to see these ESG-labeled securitized products. So for example, within the European RMBS space, we've seen a couple of Dutch green RMBS where mortgage loans are backed by energy-efficient properties. And we've seen earlier this month the first UK green RMBS. And we've also seen a social UK RMBS bond from the same originator targeting underserved communities. And within European CLOs, there are more than 20 ESG CLOs right now. And in the PRI report, we include a review of 16 European CLO transactions with ESG features from 12 different CLO managers. And what we found is that the most common ESG approach here is the application of negative screening criteria to the investment universe. And this means that specific industries are excluded from these CLO folios. And examples of excluded industries are oil and gas, tobacco, and weapon manufacturers. Industry exclusions within CLOs, however, are typically subject to a 50% revenue threshold, meaning they are only excluded when such business activities represent more than 50% of a company's revenues. And to some investors, they look like a bar set too high. In reality, it won't lead to many exclusions. So how impactful are such products in the end? I think in general, regardless of the asset class, the way to avoid greenwashing when making investments is by doing your own research, really. There is no easy way out. Engagement is also a key part in this. Investors need to be directly asking questions to the company and develop a good understanding of the business's sustainability strategy. We must fact check any ESG claims and verify if they're aligned with actions, monitor progress towards any set targets, and understand what impact they're making to the real world.
Thank you, Tina. That's certainly very complicated from the investor's perspective. In terms of our next question, in terms of regulations, how are the UK and EU regulations around sustainable investments and ESG disclosure affecting investment decisions? Is regulation helping access to information in the securitization space in Europe, in your opinion?
Okay, at this stage, I think it's a bit too early to say what impact some of these regulations are having. And I'm thinking about the EU Sustainable Finance Disclosure Regulations, for example, which came into force on the 10th of March this year. A few uncertainties are still pending, and some parts of these new regulations have not even been finalized yet. So, for example, we're still waiting for the European Commission's formal response to the letter from the Joint Committee of the European Supervisory Authorities from earlier this year in January on how to interpret the definition of Article 8 and the meaning of promotion in the context of products promoting environmental or social characteristics. Also, the Level 2 text is yet to be finalized. What I can say is that the impact so far is that it is undoubtedly accelerating the conversation on data needs. Within European CLOs, for example, we're seeing that some investors have started to request that formal language is added to the deal documentation so that CLO managers actively start collecting ESG data on the underlying loan portfolio, as is required by the EU SFDR. And some investors have said that they would not invest in deals without this new SFDR language. Another example that I can think of is that we've seen a considerable uptake by corporate borrowers of the European Leveraged Finance Association's ESG fact sheets, which outline the most material ESG topics for a given corporate sector. And this year, we're finding that more and more new deals come to the roadshow equipped with ESG data, providing investors with completed ESG fact sheets. And then for the UK, it looks like we're adopting a more climate-focused regulatory framework, given the government's announcement last year of the 5-year roadmap to TCFD reporting. And these proposals will make climate-related financial disclosures mandatory for all corporates over the next 5 years. Unfortunately, regulation is needed in this space to ensure capital is channeled towards more sustainable economic activities, and securitization has a critical role to play in this reorientation of capital.
Thank you, Tina. There's certainly a lot of unanswered questions there, but at the same time, a lot of positive developments certainly appearing there. In terms of the next question and last question, Tina, one thing we hear a lot of from our clients is the need for more consistency in the ESG space. But ESG issues are also evolving so quickly, which makes consistency more difficult. Do you think we can create ESG standards and common frameworks for structured finance whilst allowing for them to be more dynamic as ESG issues evolve? And also, finally, accounting for differences across the different sectors within structured finance in Europe.
In short, yes, that is possible, in my opinion. Firstly, there will always be a subjective element within ESG. What is ethically or morally important to me will be very different to what it is for you. Different end investors will also have different sustainability requirements. And so for this reason, I think it's unreasonable to expect ESG scores, for example, from third parties to be consistent with one another. As investors, it is more important to study the momentum of ESG scores rather than focusing on the absolute level of such scores. With regards to credit rating agencies, investors are by now comfortable with different rating methodologies, whether that is based on an expected loss or a first dollar of loss. And this should be no different for external ESG score providers. And then secondly, similarly to our standard credit analyses, different analysts can take different views on issuers and bonds. We all get the same financial data, but we may all have a different cash flow forecast and a different view on relative value in the end. The same applies to ESG analysis as well. So it is possible to create ESG standards and frameworks for securitization, as long as they're tailored to subsectors within structured finance and focus on the most material ESG topics and are also updated as the market evolves further. And this is precisely what we're currently discussing with the PRI. So if anyone listening would like to be involved in this project or find out more about what we're doing here, I encourage anyone to get in touch.
Thank you, Tina. That's very, very interesting. Appreciate you joining us today, Tina.
Thank you to Miten and Tina for a very interesting discussion. This concludes our episode. New episodes of ESG Talks air every other week. In the meantime, please visit kbra.com to access our other podcast series as well as our ratings and research.